Let's talk about something that gets almost every trader. That breakout that looks absolutely perfect, but then it just ends up costing you money. We're going to break down exactly why that happens and how one really simple rule can totally change the game for you.
Okay, so let's dive right in. You know the feeling, right? We've all been there. You see a perfect pattern, a clean break of a trend line, you jump in thinking, this is it, I've caught the big one. And then, bam! A sudden, sharp reversal stops you out for a loss. Honestly, it's one of the most frustrating things in trading.
So, this whole frustrating scenario, we call that the trader's trap. And it really feels like the market is out to get you specifically, doesn't it? But, it's actually following a logic that most of us retail traders just completely miss. Understanding this trap is, without a doubt, the very first step to finally avoiding it.
So here's the setup. You've been watching the price, you've carefully drawn your trend line, and there it is, the break. It looks like the perfect entry. The move seems to be starting, maybe your indicators are lining up, and you place your trade. Everything's looking great.
But then, almost as fast as it started, the whole thing just stalls. It's like the price hits some kind of invisible wall and then reverses, hard. It wipes out your profit and smacks your stop loss. So, what in the world just happened? Well, you just ran smack into the market's real structure, the part you couldn't see on your chart.
And here's the key takeaway. You got trapped because you weren't actually trading a change in the real trend. Nope, you were just trading a break of a line on your chart. But the market, it was still respecting its underlying structure. In this case, the last major swing high.
And this right here, this brings us to the core idea of this whole explainer, the part that busts the myth wide open. You see, not all breakouts are the same, not even close. There's a massive difference between a line on your screen breaking and the market's actual behavior changing.
This slide just nails the difference. On one side, you've got the pattern break. That's the break of the lines you draw. The source material actually calls this your imagination. Pretty cool, huh? And then on the other side, you've got the structure break. That's a break of the market's real swing highs or lows. That is the market's reality.
Okay, so knowing all this is great, but how do we actually use it? How do we filter out all those bad breakouts from the ones that might actually work? Well, the answer isn't some other complicated indicator. It's just a simple, numbers-based rule.
All right, here it is. The number that can save you from a ton of bad trades is 5%. And this isn't some random number pulled out of thin air. It's a calculated buffer that really accounts for the realities of trading. Let's see how it works.
So this is the strategy in a nutshell. When you enter on that pattern break, you absolutely need enough room to run before the price hits that real structural wall. The 5% rule is your filter. It's your safety check to make sure there's a big enough potential profit zone to even make the risk worth taking.
And this table here just makes the decision so simple. Before you enter, you measure the distance from your entry, the pattern break or PB, to that next bit of structural resistance, the structure break or SB. If that gap is more than 5%, hey, you've got a potential trade. If it's less, the professional move is to wait for the structure itself to break.
Now, I know what you're thinking. Why 5% specifically? Seems a little arbitrary, right? Well, a big part of the answer has to do with the hidden costs that most new traders just totally forget about, the stuff that eats into every single trade you make. You have to remember, every trade has a break-even point, and it is never, ever the price you entered at. If you buy at 100 and sell at 100, guess what? You've actually lost money. Your break-even point is always a little higher on a buy and a little lower on a sell because of all those costs.
And this chart shows you exactly what I'm talking about. That little 1 or 2% move that looked like a great trade, it can so easily become a net loss once you factor in brokerage and taxes. Suddenly, that tiny gap between your pattern break and the structure, well, that's not profit, it's just enough to pay your broker. Let's just look at the numbers here from the source. On a 1 lakh rupee transaction, you need to make at least 100 rupees in profit intraday, or 250 on delivery, just to break even. If the space to that next structural resistance is too small, your entire potential profit is literally just going to pay your transaction costs.
Okay, enough theory. Let's get practical and see how this all comes together into a solid, repeatable trading decision. We'll use a classic downtrend channel reversal for our case study.
This right here, this is your new best friend. A simple 4-step checklist you should be using for every single breakout trade. It's objective, and it forces you to think about the market's reality, its structure, and not just the pretty patterns you see. So, let's walk through it.
Okay, step 1. You spot the break of your trend line. This is your potential entry point. It's that moment where your imagination, the line you drew, gets broken by the price. This is the signal that gets you interested in the first place.
But whoa, hold on. Before you do anything, step 2 is absolutely critical. You have to immediately find the last swing high. That horizontal price level, that's the market structure. That's the real resistance. It's that invisible wall that traps so many traders.
And finally, the last 2 steps. The moment of truth. You measure the percentage gap between your potential entry and that structural wall. Is it more than 5%? If so, the risk to reward might actually be there. But if it's not, the disciplined, professional move is simple. You stand aside. You wait for a better opportunity. So really, it all comes down to this one question you have to ask yourself on every single trade. And making that little shift in your perspective from focusing on your own lines to respecting the market's actual highs and lows, that right there is what separates the consistently profitable traders from the crowd that keeps getting caught in the trap.